All right, guys. Welcome to Accurate Pips, and we are continuing with our free SMC trading course. Today, we'll be looking at retail psychological liquidity levels. Okay. Um, Before I dive into the lesson, if you have not watched the previous lessons, do well to watch them because you need the knowledge from those lessons to be able to grab the concept that we are going to be looking at in this particular lesson. So if you have not watched those lessons, go back, watch them, and come back to this particular lesson. And this lesson is very important to smart money trading. Okay, because smart money trading is all about liquidity. You being able to locate liquidity and using the liquidity to be able to determine your entry point, that is your IFCs and your OBs. Okay, so we'll be looking at retail liquidity, then we'll be looking at smart money traps, then we look at session liquidity, we will look at weekly high and daily high liquidities, then we will continue from there to look at entry types, which means we are coming close to the end of the lessons. So, guys, let's get into today's lesson. So, retail psychology. Um, when we talk about retail psychological liquidity, we are looking at the levels where retail traders are looking to make their entry, but in actual uh, smart money concept, those are areas rather that the money is lying. So they putting their orders over there, put a lot of liquidity in the market. Liquidity means money, orders. Okay, as I said um, at the beginning of the lesson when I was talking about liquidity. So in this lesson, we are going to be going deep into how we can identify liquidity and how we can use it to our advantage. So this is the introduction, and then in the next lesson we will go onto the live chat. So make sure you watch this introduction before you go and watch the next lesson. Okay. Now, so what is liquidity? I want to redefine liquidity so that you will not be at loss. Okay. So liquidity means the number of orders in the market when most traders are looking to buy or sell at specific points in the market, which includes the stop losses, the sell stops, the buy stops, and so on and so forth. Okay, we have a lot of them in the market. Now, if you are not able to identify liquidity in the market, it means you are going to become part of the liquidity. Okay, so always it is important for you to be able to identify where the liquidity, that is the money, the orders, the unfilled orders are in the market, that the smart money guys are going to be looking to grab that money and use it to push the market in their direction. As I said before, liquidity is like a fuel that causes the market to move up or down. Okay, all right, so liquidity acts as a fuel to push market higher or lower. Without liquidity, market cannot go higher or lower. Just like if you don't have fuel in your car, you cannot move the car up and down. It's the same thing that happens in the market. Without liquidity, we cannot move the market upwards or downwards. Okay, there will not be anything like an uptrend or a downtrend. in the market if there is no liquidity. All right. So most traders trade based on retail patterns like trend lines, um, reversal patterns like flags, uh, uh, support and resistance, double bottom, triple bottom, double top, triple top, and so on. So many different kinds of what pattern, flag patterns, wedges, a whole lot. Okay. Now all these patterns are liquidity. Okay, they demonstrate liquidity in the market, which gives us a direction. Okay, so most of the time, if you are not able to locate liquidity, that is when you end up saying that you have been hunted in the market and then the market went in your direction. No, it's because you were not able to locate the liquidity. So where you are buying from, a smart money concept trader will not buy from there in an uptrend or uh, sell from there in a downtrend. He will wait, locate his liquidity, wait for the liquidity to be taken out, then make his entry. We'll be looking at all these things on the live chat. I'll explain them on the live chat. So yours is to watch this video carefully so that when we are explaining on the live chat, you'll get a concept that we are talking about. Okay. All right. So as I was saying, these retail traders trading these patterns create a lot of liquidity in the market, which causes the smart money guys to be able to move the market in their direction without stress. Okay. All right. This gives room for the banks and institutions to manipulate these retail patterns as the fuel necessary to move the market in their direction. Okay. So as a trader, one thing you need to master, practice and master is finding liquidity and finding the proper working or reversal zone. Okay, these things are very important. That's why if you watch, I taught you a different method of confirming structure, which is different from the general structural marking that we know, that is common to everybody. Now, anything that is common and very obvious that everybody can see, an area that is very obvious for everybody to see, is always a trap. Okay, I will explain something later on, maybe when we are looking at the live chat, where I will show you. Sometimes you'll be like, oh, but the trend line, it worked too. No, it wasn't that it worked. It was just that the area that market needs to reverse from was further away from the where the trend line was broken. So if you understand what we learned previously about imbalance, the identification of order blocks, and then identification of IFCs, if you couple that with your liquidity, then you'll be able to identify, okay, the distance or the area where market will reverse from after breaking that trend line. So even as a smart money concept trader, because you know where market is likely to reverse from, you can still sell, but then you must also sell based on certain concept of smart money. You cannot just sell because there is a trend line breakout. No, because otherwise you become part of the liquidity. And you should know when to also move out. You'll be looking at all those stuffs. Okay. All right. Now, these are the places where the liquidity, that is sell stops, buy stops, SLs, as you call it, okay, or stop losses, as you call it. These are the areas that they are placed. Okay. The support levels, the resistance levels, the trend line, below the trend line. Now, and I will explain something when we get into the chart. Okay, that will be in the next lesson. Now, you realize that with retail traders, they'll enter trade somewhere and they'll go and put SL somewhere. Why? Because they are not sure of when market actually is about to reverse. But with the knowledge of smart money concept and liquidity, coupled with imbalance and the accurate identification of IFCs and other blocks, you'll be able to what? Identify these areas that market is probably likely to reverse. Okay. All right. Now, liquidity is very important. So watch this particular lesson over and over to get deeper understanding. Very important. All right. Liquidity is in different forms. That is one thing you need to note. To become a good smart money trader, you need to understand the psychology behind how retail traders think and interpret the market. So those of you that have learned how to trade based on retail areas, that is pure price action, okay, trend lines, support and resistance, uh, candlestick patterns, um, flags, wedge, um, so many. Okay, those of you that have learned about how to trade these patterns, it's to your advantage. If you're able to locate it, the next thing you need to do is, what is my trend? Are we in the buying trend or are we in the selling trend? If we are in the buying trend, then you need to begin to look for the zone below the liquidity that is in the direction of the buy. So that is the sell side liquidity that will drop into your demand or your OB or your IFC for you to take your hold, your buy, for the buy continuation. All right. Okay. So this is very important. Once you can be able to interpret what the retail trader is thinking, you should be able to translate that onto your chart. Okay. All right. So once you understand how retail traders think and look at the chart, you will be able to take better decisions against them. And then that is when they will begin to say the broker has manipulated and they have been hunted and all their stop losses have been hunted and then the market went in their direction. No, it's because they didn't understand the concept with which the market is behaving. They are not understanding the behavior of the market. Okay, so they are thinking, oh, have been manipulated. The market, the brokers have manipulated the system and I was taken out and market went in my direction, blah, 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 blah. You understand? It's not anything. You just need to understand the psychology behind this whole thing and be able to identify liquidity in the market. That's all. That's all you need to do. Okay. So as you already know, okay, from previous lessons, we have a very unique way of mapping structure, okay, which is not very common. You know, when I started teaching how to mark structure, I realized it is very different from how market structure is taught in the forex industry. Okay, so our mode of structural marking is based on liquidity. That's why I'll tell you, before you validate a pullback, there should be what, if we are in a bullish trend, then the low of the previous candle should be taken out. That's when we validate what, a pullback. If that hasn't happened, we can't validate that pullback. It's an invalid pullback. But then the retail traders will still count it as a pullback and count it as a break of structure or a change of character. Are you getting the point? And these are traps. So we have learned one of the best ways of what? Of marking structure. And if you can master that art of marking structure, give yourself 30 days. Lock yourself up. Okay? This holiday, especially those of you in school, this holiday, when you go home, give yourself the number of time you stay in the house, give period you'll be in the house, give yourself time with the chart. By the time you come back to school, you become a chart slayer. Okay, so it's something you need to look at. Okay, all right. So now, as I was saying, our this thing is based on what? Structural marking. Sorry, it's based on liquidity. Our structural marking is based on what? Liquidity. Okay, so once liquidity is taken, then we look for break of structure or change of character. Okay, this same concept is applicable when we are looking at when we are looking to buy or sell in the market. Okay, because that is what, if you remember, I told that when market taps on a demand or a supply zone, okay, then that first pullback that is taken out is no longer inducement, but a change of character on the lower time frame, which will be our entry time frame. Okay, so you need to what? Understand all these concepts and apply them together. All right. Okay, so if you can apply all these concepts together, it means that you are good to go. You get it? So to buy or sell, first you need to look for your liquidity point or area, and then you identify your demand or supply or other blocks or IFC, and then you wait for liquidation. When we say liquidation, it means you wait for the uh, liquidity level to be mitigated, okay, or to be swept. Then you can now make your trading decision based on the lower time frame uh, that you'll be using for your entry. Now, once market takes out the liquidity, you then take a trade. Okay, because even on the lower time frame, you will still apply the concept of liquidity before you make the final entry. Okay, so when trading on the
low battery, please charge.
Sorry about that, guys. So when, what was I saying? Okay, when trading on the demand zone, you have to wait for the stop losses to be grabbed. Then you make the buy entry. Okay, and if you are selling, then you need to wait for the um stop losses to be grabbed before you sell. Okay, now I'll show you all these things on the live chat in our next lesson. Before I go, if you are new to the channel, don't forget to subscribe to the channel and turn on the bell notification icon, so that anytime we upload new lessons, you'll be aware that Accurate Pips have uploaded a new lesson onto the platform. So guys, I'll see you in the next lesson, where we will dive into the live chat, and then we will see how we can identify liquidity levels in the market with respect to trend, how they call it, levels that we can trade from, and how the liquidity levels affect our entries and how it affects retail traders. All right, have a nice evening, guys. I'll see you in the next lesson. Bye.